Friends, in the chapter leverage, we have done 3 classes. We have finished 5 problems, and this is the 6th problem. You have read it in the screen. If you have not read it, I like to advise you go through the problem so that you will understand better. The problem is like this: the company operates at a production level of 1000 units. The contribution is 60 per unit, operating leverage 6, combined leverage 24. If tax rate is 30%, what would be the earnings after tax? So here they have given you 1000 units of production and contribution is 60 per unit. So if we calculate problem 6, if we calculate contribution, then it will be 1000 into 60 and it comes to 60,000 rupees. Right, so total contribution 60,000 rupees, and they have given you the combined leverage 24. Degree of combined leverage is equal to contribution by EBT. And here the degree of combined leverage is 24, contribution 60,000. This is divided by EBT. So EBT is equal to 60,000 by 24. It comes to 2,500. 2,500. So EBT 2,500, and if we deduct, this is EBT less tax 30%. This is 2,500 into 30%. It comes to 750. So earnings after tax will be 1750. Earnings after tax will be 1750. Right? So this is the problem of your problem number 6. Right? And I hope you have understood the problem. Let us go to the problem number 7. So before starting the problem number 7, I hope you will read the question on the screen thoroughly and be prepared for the answer. Right? Let us start with the problem 7. ABC Limited. Problem 7 is a little bit different type of problem where they have given you the return on equity, the financial leverage, and you are asked to compute the return on equity if the return on investment is 20%. So if we go through the problem, they have given you return on investment 20%. So first let us find out what is investment. Investment means it is owned capital and borrowed capital put together. It's called investment. So 20% return on investment, but they have not given you the investment figure. In this problem, they have not given you a particular place to start with. So in this case, we have to assume that the investment, total investment is 100 lakhs. So if the total investment is 100 lakhs and return on investment is 20%, then 100 lakh into 20%, so 20 lakh will be your EBIT, that is your return on investment. So let us start with the first assumption. Let the investment be 100. So if investment is 100, then we can say EBIT is equal to your 100 lakhs into 20%. It comes to 20 lakhs. Right? So 100 lakhs, this is in lakhs. 100 lakhs into 20%, it comes to 20 lakhs. Right? And EBT, as in the problem they have given you, the financial leverage, degree of financial leverage, this is EBIT divided by EBT. Right? This is the formula, you know this. And degree of financial leverage is given as 1.6, EBIT is 20 lakhs, and EBT we have to find out. So EBT is equal to your 20 lakhs divided by 1.6. It comes to your 12,50,000. So EBT is 12,50,000. Right? If from the EBT we deduct the tax, we can find out the EAT. So minus tax. Tax rate has been given in the problem as 40%. Tax rate is given in the problem on 40%. So 12,50,000 into 40%. 12,50,000 into 40%, it comes to 5 lakh. So EAT, earnings after tax, 7,50,000. This is your 7,50,000 is your EAT. Right? Now EBIT is your 20 lakhs and your less interest, the interest or the debt is not given, but we have found out what is your EBT. we have found out the EBT. EBT is your 12,50,000. So EBIT minus interest is equal to EBT, and so interest is the balancing figure. This is equal to 7,50,000. So friends, interest is 7,50,000, right? But I have to find out how much is the loan capital. Total capital employed, we have taken 100 lakhs, but interest is 7,50,000. But I have to find out what is the loan capital, how much is the loan, so that the remaining is your equity. But here in this problem, they have not given you how much is the loan capital, but they have given you the rate of interest on loan is 10%. It is given in the second line of the problem, that the rate of interest is 10%. So if 100 rupees is the loan, 10 rupee is the interest. If 7,50,000 is the interest, the loan will be, so loan, or you can say debt capital is equal to 7,50,000 by 10%, 75 lakh. If 100 rupees is the loan, 10 rupee is your unitary method, 10 rupees interest, 100 rupees loan, 1 rupee interest, 100 by 10, and 7,50,000. So 75 lakh is your debt or loan, right? If 100 lakh is your investment, then how much is my equity? Equity is equal to 100 lakh is the total investment, and out of that debt capital is 75 lakh. Debt capital 75 lakh. So equity is equal to 25 lakh. So equity capital is 25 lakh. Now I have to find out what is the return on equity, as they have asked you in the question. So return on equity is equal to earnings after tax. Because earnings after tax are only available for distribution to the equity shareholder. There is no preference share here. So whatever the earnings after tax, these are available for distribution to equity shareholder. This is also called shortly EAES, earnings available for equity shareholder. So EAT divided by equity capital. Then only we can find out the return multiplied by 100. EAT is equal to your, we have found out the EAT, that is 7,50,000, and equity capital 25 lakh into 100, it comes to your 30% is the return on equity. So friends, 30% is the return on equity what they have asked us in the question. So in this problem, the most important idea that they have given you the return on investment, but investment has not been given to you. Therefore, we assume that it is 100 lakhs. If it is 100 lakhs, then 30%. If you take 50 lakhs, also 30% will come. So generally, if a figure is not given, but to start the problem it is very important, we generally consider let it be 100. That was our lesson from the very beginning of the life. So in this way we can find out the return on equity, and they have given you the return on investment, that is a debt, that is your interest, that is 10%. Right? So let us go to the next problem. Before going to that, please go through the problem, note down the question, and whenever I am showing you the problem, you can also see the solution in the screen. Please note down the question and go through that. So let us start the next problem. So let us start with the problem number 8. This is also a different type of problem, and operating leverage, combined leverage is given, rate of tax is given, fixed cost is given, sales is given, and debt is given, 12% debenture, equity capital is given. They have asked you to find out the financial leverage, PV ratio, EPS, and at last asset turnover, and your comments on asset turnover. The last one is at what level of sales the EBT, earnings before tax, will be equal to 0. So EBT will be 0 at what level of sales? So lot of things they have asked you. We will go through the problem step by step. First of all, we all know the first one, we have to find out degree of financial leverage. How to find out? They have given you the DCL. We know that DCL is equal to DOL into DFL, right? And DCL is given as 2.8, and DOL, degree of operating leverage, it has been given as 1.4. So DFL is the balancing figure. DFL is equal to 2.8 by 1.4. This is your 2. So degree of financial leverage is equal to 2 times. In this way, you can easily find out DCL is the multiplication or the product of two leverage, operating leverage and financial leverage. Now we know that DFL is equal to EBIT divided by EBT. So DFL is equal to EBIT divided by EBT. We can write this EBIT divided by EBIT minus I. So here EBIT and minus I. I we can find out from the interest on debenture, interest on debt. So interest on debt we have been given the debt. The debt is 21,25,000. 21,25,000. And the rate of interest is 12%. Rate of interest 12%. So this is the loan amount. This is the interest amount. Loan amount multiplied by the rate of interest. It comes to your 2,55,000. Right? 2,55,000. So I is equal to interest on debt, that is 2,55,000. We know the DFL, we know the interest. If we put this, we can find out the EBIT. So DFL is equal to 2, EBIT we do not know, right? But we know the interest 2,55,000. So if we multiply 2 EBIT minus 5,10,000 equal to EBIT, cross multiplication this is, and if we take it here, then EBIT is equal to 5,10,000. So friends, EBIT is 5,10,000, right? So we know the EBIT, we know the EBT, we know the interest, we know the sales, and we know the fixed cost. We can find out the contribution, because contribution is equal to EBIT plus fixed cost. So we can, with this, we can totally find out all the information. So let us proceed. So let us start with the particulars here. This is particulars and this is your amount in rupees, right? Sales is very much given to you. This is 30 lakhs. It is already given. 30 lakhs sales. Variable cost is not given. Variable cost, let us keep it here. Contribution also we do not know, but we know the fixed cost and your interest. So if we add EBIT plus fixed cost, this will be contribution. EBIT plus fixed cost, this will be your contribution, and EBIT we have found out the EBIT as your 5,10,000 and in fixed cost as they given you is 2,04,000. So we can add it 5,10,000 plus fixed cost 2,04,000. So total 7 lakh, contribution is 7,14,000. Sales minus variable cost is your contribution. Now if we did sales minus contribution will give you the variable cost as balancing figure. So variable cost will be 22,86,000. So variable cost will be 22,86,000. This will be your variable cost. Now after finding the contribution, we have to less the fixed cost is your 2,04,000. Then EBIT 5,10,000. We have already found out this EBIT 5,10,000. Tax is 30%. We know the interest less interest. Interest is 2,55,000 and this is your EBT is your 2,55,000. So EBT is your 2,55,000. So from the EBT, if we deduct the tax, I am doing here less tax at a rate of 30%. EBT is 2,55,000 into 30%. It comes to your 76,500. So tax is 76,500. Now after the tax 2,55,000 minus 76,500, it comes to 1,78,500. This is your EAT. 1,78,500 is your EAT. Now we have to find out the number of equity share. We know that number of equity share, the total equity capital was 17 lakh and each share is rupees 10. So number of equity share is 1,70,000, right? So if we divide EAT divided by number of equity share, as we know EAT, since there is no preference share, so EAT and earnings available to equity shareholder are same here. Therefore, EAT divided by number of equity share, we will get the earnings per share, that is your, so earnings per share 1,78,500 divided by 1,70,000, it is 1.05. So this is your earnings per share. You can note it down. EPS is equal to EAT divided by number of equity share. This EAT, this earnings available, earnings after tax, is the profit, the earnings available for equity shareholder, right? So this is your EPS. Now we have to find out. So we find out the EPS. We have to find out the PV ratio. So PV ratio, all of you know, this is contribution by sales into 100, and the contribution as given, we find out this is your 7,14,000, sales is 30 lakhs, this has been given to you, and multiplied by 100, this will give you 23.80%. Let us check it. %23.80%, right? So we know the PV ratio. Now we have to find out the asset turnover ratio. So to find out the asset turnover ratio, we have to find out the total assets. All of we know it is a balance sheet, and they have not given you the liability, right? They have not given you the liability, but they have given you the equity. They have given you the equity, and they have given you the debt. So equity they have given you is 17 lakh. Equity they have given you the 17 lakh, and debt they have given you, the debt capital is 21,25,000, right? This I am showing you for your understanding. And liability, the other liability, current liability, etc., they have not given you. Assuming there is no current liability here, we always know the liability is equal to asset. So the asset figure, the total assets will be equal to the total liability. The total liability is 38,25,000, and the total asset is 38,25,000. So asset turnover, that is your sales divided by total asset. So in this way we can find out the total assets. So total assets equal to total liability equal to your equity capital plus debt, both the total coming to 38,25,000. So total asset equal to total liability, 17 lakh equity, and debt is 21,25,000, right? So total coming to 38,25,000. Now asset turnover ratio, this is your turnover divided by asset. Asset turnover ratio This is turnover divided by total assets, right? Turnover has been given sales, total asset 38,25,000. The ratio comes to 0.78 times. That is asset turnover. Industry, they have asked you to comment on this. The asset turnover of this particular company is 0.78. The asset turnover of the industry average, that means in the industry, taking the general average, the asset turnover of this sort of industry, the average asset turnover in the market is 1.5 and the firm has a asset turnover 0.78. Therefore, we can say the firm has the low asset turnover ratio, right? Because the industry average is 1.5 and the turnover is less than industry average. So, asset turnover is less than industry average. Industry average is 1.5, asset turnover 0.78. Therefore, we can say low asset turnover. Low asset turnover for this company. Hence, the company should increase the asset turnover by increasing the sales. Right? The last part, this problem has 4 parts. Your degree of financial leverage, PV ratio, asset turnover, and the sales for EBT to be 0. So let us come to the last part of the problem. We need the EBT to be 0, right? So if EBT is equal to 0, we all know that is EBIT less interest. This is your EBT. EBT is equal to 0. Go backward. Let us from the back, let us move over, right? And we know the interest. The interest figure is 2,55,000. Okay. So our EBT will be 2,55,000. Right? So if we take fixed cost less here, we will come to contribution. Right? And fixed cost, we all know this is 2,04,000. So fixed cost plus EBIT will give you the contribution. Fixed cost plus EBIT will give you the contribution, that is your 4,59,000. So EBIT plus fixed cost will give you the contribution 4,59,000. So friends, if we have a contribution of 4,59,000. Our EBT will be 0. Now the question is, contribution is 4,59,000. We know the PV ratio. So we know the PV ratio. PV ratio is equal to contribution by sales expressed in percentage. We know that we want the sales to earn a contribution of 4,59,000. We want to find out the sales to get the contribution of 4,59,000. So if our contribution is 4,59,000, our EBT will be 0. So let us find out the related sales contribution by PV ratio. Contribution is 4,59,000 and PV ratio is 23.80%. So divided by 100, multiplied by 100, this will come to, so sales will be your 4,59,000 into 100 divided by 23.80, it will come to 19,28,571. So this is your sales for which the EBT will be 0. So this is our sales for which the EBT will be equal to 0. So the problem is a very good problem. If there are 4 things they have asked you, I think you have understood this. If you like the video, please subscribe, offer your comments. If you can comment on a particular area where you could not understand, I will again come out with a new one or a different problem so that you can understand the things. So friends, you can subscribe and offer your comments. Thank you. We shall meet you in the next class.